Good day all. Ira Epstein with your agriculture update, and this is for Thursday, the 19th of September, 2019, and we're getting on into the 240, 245 time frame now. So today we're hearing talks that, of course, China and the U.S. are beginning their trade talks. The lower deputy levels are laying out the groundwork. What we are hoping in a monster way is that at least something on agriculture can get done, because trying to get to a total deal, that's not going to happen 1, 2, 3. We also heard from one of the president's advisors that if no deal is made, the president's considering upping the tariffs to 50 to 100%. So, you know, is that the way the president negotiates? I think we all know that is. They let out leaks that if you don't do this, that's going to happen. Energy markets up a little more today, as we're hearing that what's going on is that the Saudis have asked Iraq to give them some oil for their refinery. So maybe the situation's a little worse that we're hearing there. We're also hearing back to the corn market that our EPA is going to let us know what the president is doing for the farmers when it comes to the biofuels. There were a lot of exemptions to the refineries, if you will, those that make these biofuels, and too much was given in the opinion. So now they're trying to find a way to make corn more usage. Stock market very, very quiet today. Down day in the dollar index with most currencies up against the dollar. So let's go to the soybean chart, and we can see we still are at a period here where the market's been in this thrust, coming from this 843 area, back up now about 50 cents towards 893. And for the week on a closing basis, you are up so far about 8 cents. When we take a look at a chart, you can see how you've fallen back. Now, what I've done on this chart is I've removed the wedge formation that we had, because now it's time to look and see if there's something else that develops here. What we actually have when you look at the swing lines, and this is that same chart without the swing line, this is it with it, we've got a pattern of higher lows and higher highs, which is still bullish. When you look at moving averages, one of the things yesterday that we were talking here is the fact that the market was on the prior days able to just slice through this 100-day average when it attacked it, stayed over it. Often when you pull back as a chartist, I'm looking to see if that average will act as support on the way down. And if you take a look, yesterday you tried to get to it, you went down today, hit it right on the noggin. I mean, the 100-day average, 886 and a quarter, today's low, 886 and a quarter, and you're up. You can still slip down. The next layer of support's through here, but what about resistance? Because we say we're in an uptrend via the swing line. The bias is up when you're over the 18-day average of closes, moving average of closes, MAC as I call it. The bias is up. So I filtered the swing line with that. The resistance was right here, the upper Bollinger Band, and you certainly slid through it, and now you're pulling back into here. It puts the resistance up there again. So I've got levels of support right through here, resistance at the 904 level one more time. When we look at momentum, this is what's wrong with the market. You're overbought. So you have a market that's overbought, trying to hang on to an area of support that had sliced through as resistance, pulled back, and I would say it's some support, but you can afford to slip more here if the market wants to fall. And obviously, there's nothing that can happen right now to embed. So how do you work off an oversold condition? You either drift down or sideways as that indicator falls. If you go up from here, you stay in an overbought condition. In the meal market, we have this pattern of lower highs and higher lows. And we're fighting right at this 18-day average of closes a number of days. Now, if the market gets under 294.90, you break this pattern and you start to the downtrend looking for the 292 area, the Bollinger Band. What about the upside? If you take out 299.20, I look for 301.90. What's obvious? We're churning sideways is the obvious, and the market's looking to see if it can get anything going in a lasting trend. Right now, it's just chop city is a way to call it, going back and forth. In soy oil, you had gotten over the upper Bollinger Band. You can see that you probed it there, you kept going. All of a sudden, you started running out of your momentum. This was Tuesday's action. You had 3 days in a row over the band. Then yesterday, the market starts pulling back under the band, and today you're getting a little further reaction to that. Again, like the bean market, you're overbought. So I'd be very cautious here about what's going on. Is the market trending? It is not. You have a lower low a higher high, you had a vertical price move, and vertical moves you need to consolidate at some point or correct. In the corn market, you can see how the market has been hugging here, came back to that 18-day average, holding it. But I don't like that it's overbought, not going anywhere in this sideways camp. It's almost like meal market in some ways in the sideways action. The difference here is you're overbought. It's pretty strong resistance, 377.5 right now. Trend up, bias up, but overbought. In the wheat market, if you look here, both numbers of the slow stochastic are over 80. Now, if I come back a day, they were both over 80 and over 80 the day before. So now I've got Tuesday, Wednesday, and Thursday both over 80. They weren't that way Monday. Until the red line gets back under 80 on a closing basis, I look for this market to be supported on breaks. If it breaks from here very much and takes out the 480.75 level, you're putting into play the 475, and if that happened, you break this pattern of higher lows, higher highs. What I'm concerned about is that the market, if it goes up, has pretty strong resistance between 499.5 and 496. So far, the chart is still bullish. In the sugar market, we keep going to this 18-day average, 4 days in a row now, fighting against it. You lose the uptrend in this market if you get under 1088. You need to get a close over 1105, which it failed on. Right in the last 2 minutes of trading, it was battling 110304, and then the market, because of how they determined the settlement before the last trades, it was down at that level. Eventually, we want to move out of October into the March contract, and you don't wait that much longer, so we'll be watching this for movement on that. In the coffee market, no surprise here. We've been talking that if the market failed up here at the 100-day average and the Bollinger Band, and you had a market that did this. Let me show you. This is an outside day up. When you have an outside day up, I came up with an idea years ago, and I still follow it, that if you take out that low, it's a sign that the market wants to move to the closest of a key moving average, or it could be a Bollinger Band. It depends where it happens on the chart. In this case, it would be this average. The market took it out here. You got to bounce yesterday. That's where I think the pros went short, stops over these highs, looking for this 18-day average. They got it, and you're now back to a neutral category stance on the marketplace. In the cocoa market, it's the never-ending bull. Look at how this market keeps running. You're coming into a Friday after this type of big run-up. Be careful. You could get profit taking at any time. What the market did, and I'll take you right here. Yesterday, you finished 2401, just under the upper Bollinger Band, so getting back over it today doesn't mean anything. It's only, well, here's what it means. 95% of the time you stay within the bands, but when you get under a band and then you get the first day over it, it's just saying the market's a bit excessive. Certainly a bull market with the embedded reading, certainly the higher highs, higher lows, and if you break, maybe the 100-day average acts as a little bit of support since it was resistance for a couple of days. In the cotton market, momentum is pointing down. The bias is up because you're over the 18-day average, and the trend is up. So you have divergence right here. Support, maybe the 59.61 level, the 18-day average of closes. I don't think the bulls would want to see 58.98 taken out. If that occurred, I think they'd bail on those long positions because you'd lose the pattern of higher highs, higher lows. Momentum would probably be pushing further down, and you'd be under the 18-day average of closes. In the cattle market, we're still very much in an uptrend, but I don't know if this market's got the power in it to get up to that upper Bollinger Band. I'm starting to look at an overbought market that for 3 days in a row hasn't really gone anywhere, and it's starting to backtrack a little bit. Support back at 58.50, let's call it. I'm sorry, 98.50. My eyes again. 98.50. It didn't sound right to me. 98.50. You don't want to see this market under 97.62, otherwise you go into a sideways pattern. In the feeder cattle, you're at key resistance. You're overbought. Yesterday, I'm sure we were talking that you got now over the upper Bollinger Band, resistance, the combination of the 100-day average in that band, not in a trend per se. You've got a lower low, higher high, overbought. Today you went up to that band and you finished at 138.92. literally still above the upper Bollinger Band. I'd be a little cautious here. You got a cattle on feed report due out tomorrow, and I think a lot of traders might go to the sidelines on this type of action saying, okay, they've gotten a good rally. What are they waiting on? In the hog market, every time we hear that China, their delegation is going to the Midwest, we're hoping pork purchases. We know that China is using state reserves of pork to try to contain pricing. That is a problem for them, but where do they go out and get this pork? We're ready and willing sellers, but I think what they're doing is they need a negotiating help too. So what they're saying to themselves, well, when the negotiation gets going, we have something to help President Trump with his farm base. They need that. And I think that's going to be the very first starting area. Grain and pork. And I think that's what you're going to hear a lot about over the next coming days. You know, in a market like this, what you start looking at it, or what I do, is where's the market on the downside, upside, in terms of one of these popular tools called a pivot point. We're just talking about cattle. You're not at the upper Bollinger Band. But one of the tools I look at to see, is the market getting to the point of resistance in another area with some of the tools that day traders use. And this is not a position trading tool. This is a tool used for trying in and out during the day. You're trying to get to a market that comes down to support zones, the blues, resistance zones, and you're trying to get back to the neutral point. Some people, even if you get up to the red, they'll try to come out at this line over here. I tie it together with momentum of the slow stochastics. So, you know, it sounds complicated. It truly isn't. It's easy to understand. Making money is always complicated. You know that. But understanding the tool isn't all that complicated. What we did is we created a 3-part video series for you. So the first part explains how the formula is done. The second part, how does this slow stochastic work? And the third, how do I tie momentum into it? It's totally free. It's interesting to look at. All you need to do is go to our website, go to our free offers, click that on. We'll send it to you via a link for email. And the same thing would be here. If you're watching me on YouTube, go there and it'll take care of it the same way. I'm Ira Epstein. You have a good day, and I will talk to you all tomorrow.